8.1 million ounces. That's how much physical silver JPMorgan pulled from COMEX warehouses on January 7, 2026. Not through routine settlements, not spread across institutions. 99% of that day's delivery went to a single entity. The same bank that spent years allegedly suppressing silver just executed the largest single institution delivery grab in COMEX history. The official narrative, standard contract settlement, routine delivery procedures, nothing unusual. But the delivery reports tell a different story. On the day JPMorgan stopped for 1,624 contracts, open interest for January silver futures didn't decline. It increased by 1,431 contracts. Buyers weren't closing positions. They were stepping into an inactive month, specifically to demand immediate physical delivery. And that was just the beginning. On January the 1st, China implemented the most restrictive silver export controls in modern history. The country controlling 65% of global refined silver supply just cut the tap to Western markets. While COMEX screens showed $72 per ounce, Tokyo dealers were selling at $130, an 80% premium, the largest paper physical divergence in precious metals history. The data is screaming, and JPMorgan's move signals what Wall Street won't admit. The paper market and physical market have separated, and institutions holding short positions are scrambling to cover before the system breaks. 3 months ago, the London Bullion Market Association reported 844 million ounces in LBMA vaults, nearly 1 billion ounces in the world's largest precious metals hub. The number looked reassuring. On October 8, 2025, an Indian industrial buyer ordered 1,000 tons, approximately 32 million ounces, less than 4% of reported inventory. The market should have absorbed that order without difficulty. Instead, the London silver market froze. Lease rates exploded from 0.25% to 200% in hours. Every major dealer withdrew. Metalor, the Swiss refiner operating in 17 countries, announced it would not return until January 2026. The entire LBMA structure collapsed under a single large delivery request. The official explanation blamed logistics. The reality became clear to anyone watching. The 844 million ounces weren't actually available. Most was allocated, leased multiple times, or claimed by parties with no intention of selling at spot. Silver surged from mid-20s to over $83 by December 29th, a 147% gain. But that rally wasn't retail speculation. It was industrial entities and institutions desperately securing physical metal through any channel available. China's Ministry of Commerce made their October 30th announcement with minimal fanfare. New export licensing for silver, effective January 1st, 2026. Companies needed annual exports from 2022 to 2024, minimum 80 tons production capacity, and $30 million credit lines. Only 44 companies qualified. Western media downplayed it. Routine resource management. Nothing concerning. The data said otherwise. In the first 11 months of 2025, China exported over 4,600 tons of refined silver, approximately 148 million ounces, more than 20 times their imports. When those flows stopped January the 1st, it removed 7 to 10% of global supply instantly. And it wasn't just volume. Chinese refiners produce high-purity silver meeting London Good Delivery and COMEX standards. That metal flows directly into solar panels, semiconductors, electric vehicles. When Chinese exports ceased, Western manufacturers couldn't find replacements. Mexican and Peruvian output was committed. Canadian refiners at capacity. The physical supply industrial users depended on vanished. What came next changed everything. On December 26th, the Federal Reserve Bank of New York executed a $17 billion emergency lending operation to an unnamed institution. Christmas had passed. The financial world was on holiday. The borrower's identity remains classified for 2 years. The timing raises questions. 5 days before China's restrictions, when silver hit multi-decade highs and Asian physical premiums exploded, some institution needed $17 billion in emergency liquidity the day after Christmas. Then, December 31st, the Fed injected $74.6 billion through emergency repo facilities, the largest single-day repo injection in Federal Reserve history, larger than September 2019, larger than March 2020. The Fed doesn't publish names accessing emergency facilities in real time. We won't know until 2028. But circumstantial evidence points to stress in precious metals derivatives. When physical premiums explode and paper contracts face delivery obligations they can't meet, institutions holding net shorts face margin calls and liquidity crunches. COMEX warehouse data shows the pressure. Registered inventory, silver available for immediate delivery, collapsed over 70% since 2020. As of January 9th, only 127 million ounces remained registered. Total deliverable silver represented roughly 40 days of global industrial consumption. That's the story behind JPMorgan's January 7th move. With inventory at historic lows and premiums at historic highs, the institution that allegedly managed short positions for years grabbed 99% of one day's deliverable supply. The bank participation report from late 2025 showed U.S. banks held net short positions of 212 million ounces as of December 2nd, more than entire registered inventory. If even a fraction demanded physical settlement, the exchange couldn't fulfill obligations. But something unusual started in November. The net short position held by commercial traders began declining sharply. Week after week, short interest fell while prices climbed. Opposite of normal market maker behavior. When prices rally, market makers typically add shorts to provide liquidity. Throughout late 2025, banks were covering shorts, not adding them. The inference became unavoidable. Institutions betting against silver for years were reversing course. They weren't confident they could deliver metal if contracts went to settlement. The January 7th report confirmed it. JPMorgan, named in a 2020 DOJ case for metals manipulation, was aggressively standing for physical delivery. They weren't suppressing prices anymore. They were securing metal. February contracts saw open interest increase by 1,564 contracts that day. Buyers were rolling into near-term delivery, not pushing exposure out. The market behaved like physical silver became scarce enough that waiting months introduced unacceptable risk. Shanghai data reinforced this. Physical premiums climbed from $2 in early December to over $12 by January 10th. Indian buyers offered $10 premiums. Korean consumers paid $8 premiums. Everywhere except COMEX and LBMA screens, silver traded at massive premiums to published spot. This created obvious arbitrage. Buy at 72 in New York, ship to Tokyo, sell at 130, $58 profit per ounce, over 80% return on simple logistics. But that arbitrage wasn't happening at scale. Western dealers didn't have excess physical to ship. Inventory was committed, leased, or locked backing ETF shares. The metal existed physically but wasn't available for sale. The CME responded predictably. December 30th, They raised silver margins 23%. January 7th, they raised again to $32,500 per contract, 47% increase in 1 week. Higher margins force leveraged traders to post collateral or liquidate. When margins spike during rallies, it triggers forced selling as specs hit risk limits. The CME called it routine risk management. Volatility up, margins up, but timing told another story. Margins increased precisely when physical premiums exploded and delivery demands accelerated. The exchange making money from paper trading made it more expensive to hold futures right as the paper-physical disconnect became undeniable. The strategy worked short-term. Silver fell from December 29th's $83 to roughly $72 by January 2nd. 15% correction from margin hikes and coordinated selling. Citigroup Research estimated $6.8 billion in silver futures would be sold in early January for Bloomberg Commodity Index rebalancing. Silver's 147% gain exceeded maximum allocation. Index funds had to sell silver and buy other commodities. Citi called this flow unprecedented and outsized. They publicly telegraphed the selling, likely accelerating the move as others front-ran it. Silver dropped. Margin calls hit. Speculators forced out. Mainstream media called it a blow-off top. The rally was over, but something unusual happened. While COMEX fell 15%, Asian physical premiums increased. Shanghai premiums widened. Tokyo widened. The gap between paper and physical expanded instead of closing. Markets aren't supposed to function this way. When paper falls, physical premiums should compress as buyers wait. Instead, the correction made physical buyers more aggressive. They viewed paper sell-off as artificial and used it to secure metal before premiums exploded further. The real story played out in vault movements and delivery reports. COMEX warehouse stocks declined since October, but accelerated in December and January. Eligible inventory began converting to registered and leaving entirely. In 3 months, ending January 10th, 75 million ounces left COMEX vaults. That metal wasn't moving to other U.S. storage. It shipped overseas, some to Switzerland for Asian specification upgrades, some directly to Shanghai. The flow was clear. Physical moving west to east, paper markets to physical markets, financial centers to consumption hubs. London experienced similar outflows. Between October and December, LBMA inventory declined over 150 million ounces. Some reflected accounting changes, but significant portions represented actual metal leaving the London ecosystem. The implications became unavoidable. The 2 largest precious metals trading centers simultaneously experienced inventory drains while prices rallied and premiums exploded. Not temporary dislocation. Structural supply deficit meeting derivative market liquidity crisis. By early January, informed observers connected the dots. The pattern became clear viewed as a whole. China's restrictions removed 148 million ounces annually. The market ran deficits 5 consecutive years. Industrial demand exceeding mine production by 1 to 200 million ounces annually. Adding China's cuts meant the shortfall would exceed 300 million ounces in 2026. COMEX registered stood at 127 million. Global ETF holdings were roughly 1 billion, but most backed allocated accounts and couldn't be liquidated easily. Annual mine production was 800 million ounces, but 90% went directly to industrial contracts or coin production. The math was brutal. Industrial demand required approximately 1 billion ounces annually and growing. COMEX open interest represented 750 million ounces. LBMA trades an estimated 5 billion ounces daily of paper silver. The ratio of paper claims to physical metal couldn't be sustained if even small percentages demanded settlement. This is why JPMorgan's delivery mattered, not just 1,600 contracts, a signal that the largest, most sophisticated players no longer trusted the paper system. They wanted metal in possession, under control, deliverable against obligations. The institution, profiting for years from managing the short side, was now protecting itself on the long side. That reversal didn't happen from bullish investment views. Their risk models showed the paper market was breaking. Other banks followed similar logic. Deutsche delivered into COMEX January 7th, but was covering shorts in OTC markets. Citigroup, despite research calling for lower prices, was reducing net short exposure per bank participation reports. The pattern suggested coordination, not illegal collusion, but shared recognition that dynamics had changed. The trade working for years, selling paper into rallies and delivering from inventory during corrections, no longer worked when inventory was this depleted and premiums this elevated. Smart money was repositioning. The question was whether everyone else understood what that meant. If major banks flipped from net short to net long, demanding physical delivery instead of rolling forward, pulling metal from warehouses instead of supplying it, then the derivative market approaches a breaking point. The mechanics are straightforward, but devastating for paper claim holders. When registered inventory falls below certain thresholds, the exchange faces a choice. Allow the squeeze, meaning prices spike until users accept cash instead of physical, or declare force majeure, suspend delivery, and settle contracts in cash at exchange-determined prices. Both outcomes destroy paper market confidence. First scenario, prices explode until shorts are destroyed, and longs demanding delivery get metal at astronomical prices. Second scenario, the exchange admits it cannot fulfill its core function, and future contracts trade at discounts, reflecting default risk. A third possibility seems most likely. Paper price continues trading in a range, manipulated by margin hikes and rebalancing, while physical premiums widen until two separate markets exist. COMEX at 70, Shanghai at 90, Tokyo at 110. Each regional market prices on local supply and demand until the connection snaps entirely. This is happening now in January 2026, not prediction. Observable in real-time data. Physical silver in Asia trades at $10 to $60 premiums above COMEX spot. That gap persisted for weeks with no signs of closing. Entities understanding this dynamic act accordingly. Industrial users secure supply months ahead, paying premiums for guaranteed delivery. Investment funds convert unallocated to allocated, taking custody instead of trusting receipts. Wealthy individuals buy directly from mints, accepting 6-week delays rather than risking cash settlement. And now JPMorgan stands for 8 million ounces in one day. The signal couldn't be clearer. The institution with the most information, deepest relationships, most sophisticated risk models has decided paper silver no longer provides adequate protection. They want physical metal. What does JPMorgan know that retail doesn't? The same thing anyone can see reading warehouse reports and Shanghai data. The paper market is running out of deliverable supply. The physical market runs a 300 million ounce deficit. China cut the primary refined silver source to Western markets. The derivative structure built on assumptions of deep liquidity and unlimited supply is fracturing. The timeline for complete break is unknown. Could take months. Could happen in days if large industrial buyers demand delivery the exchange can't fulfill. October's LBMA freeze over India, his 1,000-ton order, showed how quickly liquidity evaporates when real demand meets limited supply. What's clear is the paradigm shifted. Years of silver trading in suppressed ranges while paper absorbed unlimited selling are over. The dynamic now is physical scarcity, premium expansion, and major institutions scrambling for deliverable metal before inventories run out. This isn't speculation. This is what data shows. COMEX registered down 70% since 2020. Shanghai premiums at $12 and rising. JPMorgan taking 99% of one day's delivery. Banks covering shorts after years of holding them. Open interest rising in near-term contracts as buyers demand immediate settlement. The silver market is in structural supply crisis. The paper system providing price discovery for decades is losing credibility. The institutions that benefited are now protecting themselves from its collapse. The weight sits heavy. How long can COMEX maintain inventory at current delivery rates? What happens when Shanghai premiums hit $20, $30? At what level does paper price become irrelevant? When does an industrial buyer ignore COMEX screens and only care about Shanghai physical pricing? The silver market is bifurcating in real time. One market is paper contracts on screens, cash-settled, priced by algorithms. The other is physical metal in vaults, settled by armored truck, priced by whoever has it and whoever needs it desperately. Those markets are connected by arbitrage, withdrawals, and shipping. But connections are straining. Premiums too wide. Inventory too thin. Delivery requests too aggressive. Something has to give. Either paper rises to meet physical reality, or markets separate completely. Either inventory gets replenished, or delivery requests force cash settlement. Either China reverses restrictions, or Western industry faces supply crisis, shuttering production. Institutions positioning for these outcomes aren't waiting for certainty. JPMorgan isn't grabbing 8 million ounces thinking silver might get tight in the future. They're doing it because data says it's tight now. The market is speaking. The question is whether anyone outside the inner circle is listening. This story isn't over. It's accelerating.